This is Macro Horizons, episode 353, Solace in Solstice, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of December 8th. The days are getting shorter and the nights longer, a fact of life owing to the Earth's tilt. We find solace in the winter solstice when the trend reverses and holiday gift-giving becomes imminent. Our favorite color this year is platinum, Sky Dweller. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, the economic data cemented expectations for another 25 basis point rate cut when the Fed meets on December 10th. Specifically, ADP for the month of November showed a decline of 32,000 jobs. This largely served to reinforce the notion that we're in a no hire, no fire labor market at the moment. Consistent with this was an unexpected drop in initial jobless claims to 191,000. Now, there's legitimate concerns about the seasonal distortions associated with the Thanksgiving holiday because of the timing of the holiday this year, so we're content with discounting that particular measure. We also saw the Revelio print at negative 9,000 for the month of November, and that compares with a downwardly revised negative 16,000 in October. Overall, the theme for the employment proxies has been mixed to weaker. As a result, not only has this firmed up expectations for a Fed rate cut, but it also reduces the probability that Powell strikes a particularly hawkish tone at the press conference. We've seen the price action in the Treasury market follow what should generally be expected, with the 2-year yield anchored at 350 and 10-year yields in a range between 4 and 415. As we contemplate what it will take to break this range, the messaging from the Fed could be an obvious inflection point. If not, then we will need to look to the following week, in which the BLS releases the payrolls print for both October and November, as well as November's CPI data. As a theme, our take is that the labor market outlook is continuing to dim, and while we are certainly cognizant that there are market participants who expect the next few months will be characterized by a restarting of jobs growth, we find ourselves a bit more skeptical of that narrative. This is reinforced by the continued headlines about large-scale layoffs and, of course, the employment proxies. It's also worth noting that within the ADP series, we saw all of the job losses coming from smaller businesses. This is very consistent with the fact that smaller businesses are reportedly suffering more from tariffs and the trade war uncertainty. It will be worth following this series to see if, in fact, those job losses spread to medium and large-sized firms in the near term.
Well, at some point over the last several weeks, there was doubt that the Fed was going to be bringing rates lower at its final meeting of the year next week. But between some of the rhetoric from the likes of William and Waller, coming into this week, we saw a return of market pricing to nearly 100% odds of another 25 basis point cut in December. And if there was any doubt that the Fed was going to continue easing, this week's marquee data release in the form of ADP, which showed a 32,000 job contraction in terms of private hiring in November, has cemented the prudence of another 25 basis point cut and demonstrated that, at least in November, the labor market continued to cool. Now, this leaves the question of how Powell is going to characterize next week's cut. Is it going to be of the insurance variety, or is it simply the latest step on the journey closer to neutral? Unfortunately, there won't be a payrolls report to inform that debate on the FOMC, but at this stage, in looking out into 2026, it's that dynamic which is occupying investors' attention as the outlook for next year's U.S. rates market is refined.
And it goes without saying that the jobs data is in the driver's seat for the Fed. We have moved past peak reflationary angst that really characterized the summer months in the Treasury market. We have now seen that there was some tariff pass-through, but it has been reasonably well contained. And perhaps more importantly, the core inflation measures haven't managed to materially accelerate to the point of becoming troubling for the Treasury market or monetary policymakers. For evidence, we look to 10-year break-evens, which are still sub 225 basis points. Now, when we look at this series over a 25-year history, what we see is that the average is 207 basis points. So we're still above the long-run average, but nowhere near the 300 basis point peak seen during the pandemic. We maintain that as long as tariff pass-through is spread out over a longer period of time, then we won't see forward inflation expectations reset to a materially higher plateau. In fact, in considering the year ahead, as the realized inflation data comes in, we expect break-evens to drift lower. When we look at the period between 2014 and the end of 2019, what we see is that break-evens averaged 178 basis points. We're using this as a medium-term target for break-evens once the market is convinced that inflation has in fact not only not re-accelerated because of the trade war, but also continued to moderate as some of the key distortions created by the pandemic have worked their way out of the real economy. It's with this backdrop that we remain reasonably constructive on the Treasury market, with one key caveat. That caveat being the global sovereign debt market. As we've seen with JGBs and EGBs and gilt yields, there's stickiness to the upside. Now, while we have seen a bit of decoupling from other major sovereign debt markets recently, we expect that the broader global fixed income market has prevented 10-year yields from sustainably trading below 4%. So while not directly bond bearish for treasuries, the global sovereign debt market has prevented a more material rally. There's also the Hassett factor. As we've heard indirectly from the administration, it appears that Hassett is the front runner to replace Powell. Trump has very specifically said that he will announce his nomination for the Fed chair in early January. That means that we could still conceivably see tradable headlines on the issue. However, the notion of Chair Hassett is being normalized within the market. Investors' primary concern is one of Fed credibility. The perception is that Hassett's close ties with the White House could lead him to be more biased towards cutting rates and an accommodative policy stance than might be warranted by the economic data. As that baseline, we do take solace in the fact that Hassett would have one of 12 votes on the committee, and that means that he would be required to build a greater consensus among the other voters. And ultimately, that consensus would need to be driven by the economic data. We're certainly cognizant that there have been some concerns that the administration will continue to try to appoint Fed governors at a pace that would allow their appointed governors a majority on the committee and therefore the ability to either confirm or reject regional Fed chairs when that process occurs early next year. Keeping in mind the timeline, it's important to note that for the administration's objective to be achieved, they would need Cook's seat to be vacant. The Supreme Court is expected to hear the Cook case on the 21st of January. The spread between the 21st of January and the 1st of March is very narrow in terms of how long it typically takes the Supreme Court to issue a ruling. As a result, we're less concerned about this notion that the administration is going to be able to create a hyper-dovish Fed in 2026. So in keeping with that theme, we do anticipate that Powell won't be especially hawkish at the press conference, perhaps something more balanced, simply reflecting the economic data, and we will also look to the SEP and the beloved dot plot without the cynicism that we might apply if we truly thought the administration was going to be successful in their attempts to create an uber-dovish FOMC next year.
And from a higher level, this gets at what is becoming an increasingly apparent structural shift in terms of the global economy and in terms of, at least in Washington, the monetary policy landscape. Clearly, Trump's trade war has created a far more fractured global trade environment that has driven more onshoring not just in the U.S., but similarly in the other countries that have been impacted by tariffs. It goes without saying that much of the global economy is very reliant on the United States, whether that's from an access to consumer markets perspective, a military perspective, or simply an outright economic support perspective. Much of the world has now rethought their reliance on the United States. Europe comes to mind, many parts of South Asia come to mind as well. And what this has translated to your earlier point, Ian, about the price action in other sovereign bond markets, is what will likely be an enduring shift toward higher costs, higher borrowing, and in turn, probably higher rates, which won't directly dictate the outright level of 10-year yields in the U.S., but it does imply a relative floor on how far U.S. yields will be able to fall over the longer term, simply given that there will be a natural cap on the spread between boons and U.S. 10s, for example. Add to this the idea that even if in the near term we're not going to have a board of governors at the Fed that are entirely chosen by President Trump, there's no question that the political influence that's being exerted on monetary policy decision-making is much higher than it's been in a very long time, maybe ever. And so, as we think about what this means for the interest rate landscape on a structural basis, we could be entering a regime where the Fed is not giving up the 2% inflation target, but the Fed is starting to seem much more comfortable with inflation above its 2% target. And especially if we have an inherently more dovish FOMC, then maybe that means, barring a catastrophe in terms of the labor market, that we're not going to see one-handle or two-handle 10-year yields at any time in the foreseeable future.
And that certainly bodes well for the curve steepening trade that has been thematic, certainly as one of our core calls in 2025. We're rolling that forward to 2026, and we continue to see both the fundamentals as well as the flow and supply concerns aligning to a steeper curve. In the event that Hassett does in fact get the nomination, we would anticipate that the curve steepening momentum would only increase from here.
So, Ian, it looks like there will be 25 basis points under the tree after all.
Looks like Santa Claus isn't coming to town.
I got a rock.
In the week ahead, the biggest macro event of the week comes in the form of the FOMC rate decision. The probability of a 25 basis point rate cut is effectively fully priced into the market now at 100%, and expectations are for Powell to strike a more balanced tone at the press conference, while keeping in mind that the Fed has a strong incentive at this point not to pre-commit to a January rate cut or a January pause. So we expect that the messaging will be that monetary policy decisions are shifting to the mode of being meeting by meeting, and the outcome of January will largely be contingent on the economic data in the intermeeting period. It's also worth noting that the next few weeks will be the last period before Trump announces Powell's replacement. And of course, whoever the candidate is will still need to pass congressional approval, but in light of who is on the short list, we don't think that that will be an issue. Among the Fed events, we will also see an update to the summary of economic projections and the beloved dot plot. As of September, for 2026, real GDP was seen at the long-run average of 1.8%, and we don't see an obvious reason for that to be revised. The unemployment rate, at 4.4 for 2026, however, could be revised slightly higher. 4.5 or even 4.6 would be reasonable, given the current trajectory of the unemployment rate. Recall that the Fed's core inflation projection for next year, as of September, was 2.6%. We expect that that number will remain unrevised. More importantly, the Fed funds rate projection for 2026 was 3.4%, whereas the current market pricing suggests that it should be 3 or 3.1. We anticipate that simply the process of marking the dot plot to market would result in a downward revision to the 2026 dot. This is also consistent with some of the weaker aspects of the economic data that we've already seen, as well as what appears to be justification for an increasingly dovish bias among monetary policymakers. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. As it appears Santa Paws has fallen victim to Jack Skellington, our thoughts are with him. Watch out for Oogie Boogie. He's not Kenny Rogers' gambler. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.